Welcome to Value Research Helpline. I'm here to answer your question, and let me start quickly. Sandeep is asking that I read that Blackstone is acquiring L&T Mutual Fund. How will it affect my investments in the fund? Should I exit the fund? Yes, this has been talked about for a while, and L&T Mutual Fund itself got created by acquiring Cholamandalam Mutual Fund and Fidelity Investments, Fidelity Mutual Fund. And there are talks, and many a times management has denied. I would say that sometimes these changes are for the better, sometimes these changes are for the worse. But continuity of fund manager, that is a critical thing. When Fidelity funds were acquired by L&T funds, I had concerns, and that concern was primarily because L&T Mutual Fund was acquiring the mutual fund all the funds under its management, but the equity fund managers were not coming over. So that turned out to be true, and but L&T Mutual Fund was able to attract other fund managers or good fund managers and did a reasonable job. So wait for it. You don't necessarily need to act on every action. The change could be for the better, change could be for the worse. But important thing is continuity of fund management. Is there going to be any significant thing? But by and large, I would say that if a fund company is put on the board, on the block, it can have, mutual fund business is people's business, and there could be anxiety, there could be concerns about who the future owner will be, how the management will be. I'm little comfortable with L&T Asset Management Company simply because it's a management-led. L&T, the owner, it's a management-driven led. It's not one owner, and it'll bring about a completely different kind of. I hope that any change in control of the asset management company will provide continuity of management. Otherwise, it will not be worthwhile for a private equity investor to acquire a company without its people. So, had it been a bigger company acquiring L&T to merge to acquire, so that can lead to a lot of turbulence, a lot of changes. Not in this case. The company is likely to be acquired by an owner like this with all its people, because the company will be worthless without its people. So, I don't think you need to really act in a huff. Vinesh Mathur is asking that please recommend a secure agency to track our funds. Tracking mutual fund is very easy. Just come to Value Research, request for your consolidated account statement from CAMS through our interface, register for free, upload your account statement, and you are all set. You can actually track your investments very well. Not only track your investments, we will provide you all kind of analytics which you annualized return of your SIPs updated on a daily basis, the underlying portfolio. Not only that, it is much more than mutual fund. Many people have their public provident fund or their employee provident fund or their NPS account or their fixed deposits or their stock portfolio. There are beautiful features in this portfolio tracker, and for many years, for nearly 2 decades, we have millions of investors who track their investments here. I think it is the most intensely it's the most, I would say, rigorously designed thing. Let me just list you some of the things that you can do, which is unique to Value Research My Investments, what you call is Portfolio Manager. One is that you can put all your investments together, mutual funds, NPS, stocks, bonds, funds, PPF, all of it. And as a result of this, it is able to aggregate. You can really discover what you actually own. You own some equity fund, because of which you will be owning some 50, 70, 80 stocks. Then you have some shares which you have bought. So if you want to find out that how much of your money is in Infosys, the portfolio manager is able to aggregate your investments in mutual funds, the proportionate investment. If you have 1 lakh rupees in a mutual fund and 3% of that money is in Infosys, which means 3,000 of your investment is in Infosys. Then you have Infosys shares bought directly, which is worth 10,000 rupees. So you can get an aggregate. You will get that 13,000 rupees of your money is invested in Infosys. So it aggregates the underlying portfolio, and it changes every month because the portfolio disclosures are every month. So you really know what you own. There is no other mechanism whereby you can discover what you actually own. And it will aggregate even for the NPS, because NPS can also be a holding of bonds and funds. About your bond fixed income holdings, it will tell you what is the credit rating of your individual, what is the credit rating breakup. So effectively, for all your investment, the kind of fact sheet which you get for a mutual fund, you are able to get all the information that is there in a fact sheet through Value Research Portfolio Manager. And this, I think, is a very unique thing. There are a lot of other small nuances. For example, when you invest in a stock, you buy it at 100 rupee and you hold it for 5 years. During this period, there was a bonus issue, or there was a split in the shares, or you got some annual dividend. So the return that you get on Value Research Portfolio Tracker is adjusted for all the interim returns that you are deriving. It calculates the total return during your holding period. And that is the most accurate holding period, because many a times we lose perspective. We just thought that we bought something for 50 rupee and it is still 70 rupee. And we tend to forget that we got some 13 rupees in between. And that is also your return which you got periodically. So don't miss this thing. It's a free service, and only, I think, we do it very rigorously. It amounts to beating my own drum, but I'm very proud of doing it. And I use Value Research Portfolio Tracker for all my investment, and that is how I, all the features which I think it should be there, I work towards enhancing it, and we will keep enhancing it forever. Kapil Parulekar is asking that I plan to include Motilal Oswal NASDAQ 100 ETF in my portfolio. Is it wise and safe to invest 25% of my portfolio value in it for the long term? Yes, by all means. I don't know whether it is convenient to buy ETF, because the ETF, the NASDAQ 100 ETF, the trading volume and the trading pattern is quite erratic. In fact, it has improved quite a bit ever since the NASDAQ 100 fund of fund was launched, because that has created an additional market for that. But when you are buying an ETF in the market, the way of buying an ETF is that you go to a stockbroker and you place an order, and the price is expected to be anchored around the NAV. So there is always a small premium or discount. So if you get it at a discount, fine. If you get it at a premium, then there is a problem. You are not buying it like a mutual fund. So in that sense, buying this ETF is a little complicated. Buying the fund of fund also, is not able to replicate the performance of the NASDAQ 100 with precision. There is a, far greater divergence there. But still, NASDAQ 100 as an investment is a great vehicle. I think, it is, if you have made up your mind to invest 25%, I am nobody to question it. I think it's a good idea, because I evaluate every investment based on the underlying investment. They are promising companies, they are technology companies. These are the kind of businesses which is not otherwise accessible to Indian investors. And it is also low cost. Low cost, but this trading inefficiency and the divergence of the fund of fund relative to ETF is a concern for me. And but I don't think there is a way around it. For convenience, go for the fund of fund. You will be able to do a programmed investing. Some months you will win, some months you will lose, and there will be a little bit of advantage, disadvantage on a month-on-month basis, which is not predictable. And on a 5-year, if you are thinking of 5-year, 10-year term, it will all average out. Get going. Bapu Deshmukh is asking that, can you please include InvIT investments in my investments? They do not figure, and thereby the true return of InvITs are never reflected in the portfolio. Yes. Thank you, Bapu, for this suggestion. There are few InvITs which are listed, and we will include that. And few more are in the pipeline. They are likely to be very big issues, and they are likely to be very popular too. So we will add InvIT into making my investments better and more comprehensive for you. I've noted this suggestion, and I'll be sharing it with my technology team to enable it as early as possible. Ashish Tekwani is asking that, does investing in multi-cap plus hybrid plus fund of fund make sense if someone doesn't want to go the blue chip plus debt plus gold mutual fund route? Yes, I would say that just multi-cap plus fixed income. I don't understand why fund of fund. Are you referring to some international funds to be acquired here? If that is the case, fund of fund is just a method. Most fund companies have found it convenient to invest in an existing international fund. That makes it easier. It has a history, and there's a credible fund manager managing it. So I would say that multi-cap plus international fund plus fixed income, because that will give you, or if you are trying to derive fixed income from a hybrid fund, you will have to keep an eye on the asset allocation yourself and use value research my investments more closely, and it will be able to give you a very precise measurement of how much of your money is in cash, how much of your money is in equity, how much of your money is in fixed income. So by all means, if you want to achieve your fixed income allocation through a hybrid fund, do that. Equity, multi-cap, international fund and hybrid or fixed income is a good way of building your portfolio. But I think the critical thing is, keep investing regularly. Keep only the ground rules you should not forget, that keep investing regularly, only put your long-term money into equity and do some periodic asset allocation, set your asset allocation and periodically rebalance it. Sanjay Dongre is asking that when switching from non-performing to a performing mutual fund, how do I determine if I am purchasing the performing fund at a higher price? It may happen that non-performing fund will perform better later, while the performing fund purchased at a higher price may not give expected return. One is that, the price of a mutual fund doesn't matter. If there is a fund which is at 100 rupee and the NAV of a fund which is 15 rupees, it doesn't matter. If both funds are just run as well and they do just as well, then your 100 rupee will become 200 and your 15 rupee will become 30. And in both cases you will earn 100%. So whether it is 15 or 100 doesn't matter, because how the underlying investments do, that is the most material thing, that is the most important thing. And when you are evaluating a fund, the simple way of looking at it is, you bought a fund and you expected it to do well, and now it is doing poorly as compared to the benchmark. It is doing relatively poorly compared to the other funds of similar kind. That is the time to call it quits. But what is the time period you should take? I would say that, at least 1.5 time, market cycle. Some down period, some rising period. And if during this period the fund has actually done poorly relative to its benchmark and relative to its peers, get rid of it and replace it with something else which is doing better than others and better than the benchmark. And that is what we pay an active fund manager for, to beat the benchmark, and at least not on a narrow time frame of 3 months, 6 months, 1 year, 2 years, but over some market cycle which takes into account a rising as well as a falling phase of the market. So be guided by that. Don't be guided by recent past performance. 3 months, 6 months could be quite misleading. Anirudh Majumdar is asking that I'm 24-year-old and currently have one large cap, one mid cap, one ELSS and one multi-cap fund. I want to stop the ELSS as my 80C limit is covered. Should I wait for clarity on how multi-caps will function before reorganizing my portfolio? No, don't stop investing. If you are investing for the long term, choose some focused fund. Choose some large and mid cap fund. You have good enough funds to choose from. And because this ambiguity, it will get fixed by 1st of January. That is the deadline. And if you have to, and don't clutter your portfolio, just have one, and that is all that you need. So carry on with your investments. Discontinue investment for don't look for an excuse. Invest. Don't stop investments. Jignesh Joshi is asking that how do I upload my investments from CAMS? I'm struggling to do it these days. Oh, write us a mail in greater detail. Where are you struggling? Because we are trying to streamline the assimilation of the CAMS portfolios, or the consolidated account statement from CAMS, and there has been a little bit of process change. We are trying to make it perfect. We are trying to make it seamless. We are trying to we have tied up with CAMS to make it very efficient without any you will get your account statement to your mail account. We never get access to it. And you have to upload that portfolio, that account statement at Value Research online. So try it once again, share it with us in greater detail, and we'll be able to help you. Ashok is asking that, what is your take on the newly announced risk-o-meter mandated by SEBI for mutual funds? Will it make the star rating by Value Research and others redundant? No. Risk-o-meter is slightly enhanced. It will get, compared to what was in the past, it was a 5 scale, now it is, more scales, more gradations. It will be, earlier it was, linked to the category, now it will be linked to the category and forever. Now it will get revised periodically based on the portfolio characters. So risk-o-meter is only going to indicate a broad, it is a broad, I would say, gauge to measure that how risk, it is a very indicative, broad indicator of how the riskiness of a fund category, so to say. I don't think, the rating is a little different. It is a relative gradation of funds in a particular category based on their risk-adjusted performance over a defined time period, 3 years and 5 years, for all equity funds. So the objective of a rating is to find out, which funds have done better on a risk-adjusted scale in its own category, as compared to risk-o-meter, which is only going to tell you that how risky is the category, and if there is a little bit of change, I have to see that how this the risk, the definition of or the guidelines for the risk-o-meter, which is quite elaborate, as they are out, fund companies will make sure that funds don't change on the risk-o-meter, which means that it will also modify their behavior, the way they will be conducting or the way they will be building their portfolios. So I don't see any conflict there. Risk-o-meter is meant for the naive investor because risk-o-meter is just trying to be little, the SEBI's objective is that there should be no mislabeling of a fund. If a fund has a certain kind of risk, then that risk should be stated upfront and very clearly through the risk-o-meter. And whereas the rating is trying to tell you that which funds did well relative to others or did poorly relative to others in their respective category. Amit Bakre is asking that if you continue to hold a specific mutual fund for a long period, do the expenses charged continue to increase? Should I continue to hold for a long period or redeem, say, after 15 years? No. The fund expenses do not increase because of your holding period. In fact, the fund expenses rules are pretty straightforward. Fund companies charge the mechanism of expenses that as a fund gets bigger, fund companies are supposed to lower the expenses. Expenses come down as funds get bigger. And there is a very clear formula around it for the first 500, next 500, and so on and so forth. And subsequent, as funds get very large, more than 5,000 crore, on every 5,000 crore, there is a 5 or 10 basis point reduction. So I would say that it has nothing to do with your holding period. Smaller funds charge more, or they are allowed to charge more. Bigger funds, they have to charge less. And it is a very mechanical process. There is a formula around it, and it is very precise. I don't think fund companies can actually fiddle with that. If a fund is, you are holding a good fund for 15 years and it is it continues to do well, keep holding it. The only reason why you should sell a fund or you should change a fund if it is, is when the fund stops doing well relative to others and you have superior option, or when you need the money. And so just be guided by these two things. Just a fund has become old or you have been holding it for a long time does not necessarily mean that you should sell. And then more so for expense reasons. Expense will only go down if it gets bigger. Suman Sethi is asking that I am 61-year-old and I have 4 crore in savings, 50% in debt, 50% in equity. I am retired. I have a house and my child's education is taken care of. How much can I withdraw monthly so as to safely take care of inflation? Do I need to rebalance or do I need to transfer all assets to equity? I would say that, you should not be guided by how much money you can take, because, by this yardstick, for every crore of rupees, the most conservative, withdrawal rate should be 4%, and that will mean 16 lakh rupees annual withdrawal is something which will make sure that your money will keep growing, and at the same time I feel that 4% withdrawal rate will be reasonably conservative, and if you are able to make your living with 16 lakh rupees per annum income from your investment, then your money will keep growing, and it can rise in line with inflation, because 3 years down the line you would have grown up capital. This 4 crore will be actually a little more, or maybe 5 crore. Then you will be the 4% of that 5 crore will be 20 lakhs. Simply because I expect that a return of anywhere ranging between 7 to 10% or 11%, given the current inflation rates and interest rates. And if you are doing a 50% allocation to equity and 50% allocation to debt, withdraw your money from fixed income, and then periodically rebalance it. Periodically rebalancing will itself add some significant value to your will add some return to your allocation, and there will be a method to it. And annual rebalancing, or if this 50% ever becomes 55%, rebalance. Rangarajan Anandakrishnan is asking that I have been living in Gulf for last 29 years. I plan to return to India early next year. I want to earn regular income from my savings. Please advise a suitable investment plan. There is an article on Value Research online, how to derive income in retirement. Go through that article. It's pretty elaborate. It will give you a method, or it will give you a method as well as the rationale. And once the Value Research Premium is live, use the portfolio builder. It will give you a very precise recommendation in terms of how to build your portfolio. You will find it very useful. Pranay Pendarkar is asking that when should one switch from mid-cap to a large cap and index fund? If you are not well diversified, look at your My Portfolio. You will get a sense of how your portfolio is spread, and you don't necessarily need to switch. I think all these things are cyclical. Large caps do well, and once you have belief in the fact that large caps are doing well and they will continue doing well, something else starts doing well. And 2 years back everybody thought that small caps will continue doing well, and that is when they turn around for the worse. So I would say that, and that is why you should diversify, and that is why you should have multi-cap fund, and that is why or the way to have multi-cap is to have large cap, mid cap, small cap in certain ratio. I would say that 60 to 70% in large cap, next 20-25% in mid cap funds, and 15-20% in small cap fund. Gets you a diversified portfolio. Periodically rebalance, end of the story. Or for simplicity, have your multi-cap fund directly. That's the way to approach it. Don't try to jump, because if you try to jump from large cap to mid cap to small cap when they are doing well, you will run the risk of getting caught on the wrong foot. You will end up chasing something which is doing well, and once you get into it, it will stop doing well, and something else will start doing well, from which you have moved out. And most of the big moves in different segments of the market, large cap, mid cap, small cap, different sectors, they come when you least expect it, and they disappoint you once you have an absolute faith. And we are all biased. We are predisposed to be chasing what has done very well in recent past. We try to ride the bus while the going is still good, and sometimes it works, sometimes it is extremely disappointing. So I would say that diversify methodically. Deepak Parikh is asking that I'm 62-year-old enjoying partial retirement. I've invested rupees 15 lakh each in Pradhan Mantri Yojana and Senior Citizen Savings Scheme. I have 10 lakh in FD for emergencies. We have ample couple Mediclaim coverage. Few of my insurance policy worth 30 lakh are maturing next year, and I have rupees 1 crore invested in mutual fund. Am I doing okay? Yes, I think you have taken good step of having, building the foundation of your portfolio, which is through this guaranteed income, reasonable yielding and absolute safe investment avenues. And I think it requires some careful planning in the sense that you are in partial retirement, which means you have some income and you have these investments which are generating returns. How much income do you require? You need to do that estimate. And what are the other expenses, any big spending plan that you have, and plan accordingly. Use value research portfolio builder to plan these. You can put all your investments together and do your estimate of how much monthly income requirement you require, and accordingly allocate things. You have done a good foundation. Even if I were to recommend, I would say that this is the starting point of any person retiring, because I would look all these as fixed income allocation and then build equity and fixed income funds over and above this. But most important thing is to estimate your income requirement and the capital that you have, and the best way to deploy the remaining money that you will get. Rohit Bakare is asking that when rebalancing, if my equity portion is up by 10% and I hold 6 mutual funds, what percentage should I redeem from each mutual fund? 10% each of different proportions from each mutual fund? Please note that I own small and mid-cap funds. Define some rules for yourself. The simplest thing which you can do is what you are stating. Redeem proportionately. But I would say that there could be other way of doing it, which is rebalance even among your funds. So that will create something which has done well. You will be taking money out from there. Something which hasn't done well, you will be taking less money out from there. There is the other way of looking at it. Sell your losers and run with your, hold your winners. So, you can take any of these three things. If you are actually investing for next 10-15 years, all of this will work well. But choose one method and stick to it. Dilip Patil is asking that I'm a retiree. For supplementary regular income, I can park 40 lakh in Dynamic Asset Allocation Fund for 5.5% yearly SWP with incremental yearly increase of 5% over 5.5%. I don't think, I have not been able to find, I don't find Dynamic Asset Allocation Funds as great performers. I'm a great believer of asset allocation. But I don't think, in these 15-20 years, the Dynamic Asset Allocation Funds which have existed, some of these funds have been able to protect well on the downside. But I don't think they have been a winner. You can't be a winner with this. I think asset allocation in a more disciplined way, whether you do a 50-50 or 2/3 equity, 1/3 fixed income, 2/3 fixed income, 1/3 equity, do your rebalancing. It will be cheaper, you'll be in greater control, and I think you will not compromise on the performance, because I think discipline is the name of the game here. I would like you to deal with it yourself, do little work, and I don't think it's too much work. 1 or 2 actions in a year with mutual funds can help you do that. Use value research online. It gives you a very precise asset allocation on a month-on-month basis, and you'll be able to guard your downside and some of the big opportunity that comes in the market, like in March. And if you are disciplined enough, you'll be able to benefit from that. I have found that many of these dynamic asset allocators, they have not built a credible case for themselves. Satish is asking that experts nowadays recommend only index funds, but I feel that these funds are neither able to beat the performance of active funds nor provide downside protection. Moreover, they are forced to hold all stocks in the index even if a company is in the news for poor governance or fraud. Help. Satish, I just can't agree more with you. I'm not a great believer of index funds right now. In fact, last 1.5 years has been good for index fund because the large caps have done well, and that too in a very narrow way. 3-4 stocks in the large cap indices, Sensex and Nifty has done well. Some index funds have become larger for very different reason. Simply because Employee Provident Fund Organization and NPS has started investing. and they have started investing in these index funds for their own reason, low cost and the institutional accountability. It is very difficult for these faceless organizations to choose an active. They will be charged of, there will be a vigilance inquiry for choosing a certain fund against others and all that. Index fund is a no-brainer. And they are able to get low cost equity participation. That's about it. So I agree with you. I'm still a believer of actively managed fund. Of course, large cap funds you can avoid, because I think if you have to invest only in large cap fund, index funds are better option. But when I look at all other parts, and and there, we are looking at a very narrow time period in which many funds are underperforming. But one has to look at you have to look at the way we invest. We start with 5,000, and with our rising income we start investing more, and we invest every month, and you have to look at the performance over these time period, over 5-year, 10-year time period. When I look at such returns, I think active funds beat index funds hands down, and the discipline and the convenience. There will be a time when index funds will have, these actively managed funds will face greater difficulty in beating the index, even over longer time period. But I think the jury is still out. Guru Kale is asking that I have invested in some stocks like HUL, Britannia, ITC and Infosys for 3-4 months and received some dividends, though not sufficient. I am looking for some stocks or mutual funds from which I can get a regular income of at least 2,000 rupees. Please let me know if possible. Yes, look for some high yielding stocks, or 2%, this kind of invest 2,000 rupees per month, which means 24,000 rupees a year. Think of the capital where you can get this much return. I think in mutual fund you can do a systematic withdrawal plan by investing a certain sum which translates into 3 to 4% of that money is 24,000 rupees. 24,000 rupees a year, which translates into 2,000 rupees a month. You will really need about 6-7 lakh rupees, and that will help you do that. The money will grow, and you will also be able to put a amount. This is the simplest way you can do it. The other way is buying 3-4. If your income requirement is less periodic, you don't necessarily need 2,000 every month, but somehow you need 20-25,000 rupees a year. Some high yielding stock can actually be concentrated yet rewarding. And look for if you have not for you, because I would like you to progress with mutual fund and a systematic withdrawal plan with your investments. Even in an aggressive hybrid fund will do that. But somebody with a larger amount, he should, if you look at our stock advisor service, Value Such Stock Advisor, there are at least 6 to 7 such stocks which are yielding very high, and I'm hopeful that they will also be great compounding vehicles over a period of time. So the yields might look like 4 to 6% today, and they are growing. These companies are growing. They are growing their revenues. They are growing their profit, and their dividend is also very high, and they have a very high dividend payout ratios too. I get on to the last question. Rajiv Menon is asking that the EMI on my home loan is 25 lakh rupees, and which is 30,000, for which he is paying a EMI of 30,000 rupees per month. He's supposed to pay only 26,000 rupees, but he's paying 4,000 rupees extra. 10-year balance, there's still 86 months is outstanding at the rate of 7.2%. This loan is in NRI category, so I don't get any tax benefit. My desire is to close this loan in 2 years. Please advise. Yes, if you're not getting any tax benefit, you can wind it up. It's always good to be, free from debt. Normally, I don't encourage investors to, the only borrowing which is justified for an individual is the home loan, because they are generally low cost, they are long-term tenure, and if you are investing for 10-15 years, you end up, the long-term return on any hybrid portfolio will also be more than the cost that you are incurring here. But if you will derive mental peace by, clearing your debt on your home, it is good to get rid of it. So thank you very much for joining in, and I'll come back to you with the helpline once again next week. Thank you.